Hey guys, Mike here. So today we're going to talk about a lagging indicator that pretty much shows, where we're at, why we're here, and then until this happens, like you can pretty much forget about any big move up going on in the market, to be honest with you. And of course, you never use one indicator by itself, so to speak. But this one we've talked about before in the past, and it really, if you think about it, lets us know why we're here. It kind of point us in the right direction, and we kind of talked about this prior to November, but looking at this, hopefully we'll understand a little more about it. And so we're going to get into that and exactly what we need to be looking for if we're going to have another big move up, which maybe this year, maybe next year, whatever. But until this happens, it doesn't matter. Okay, that's just the way it is. And before we get into it, I do want to say one quick thing. I was thinking about this driving my son to school and talking to you guys and the comments and emails, whatever we're doing here, and hearing people out there. I know there still is a lot of confusion as to why the Fed wants to do what they want to do, right? Raise interest rates through the roof and run off their balance sheet and all this stuff. And I'm going to put a simple analogy because honestly, I'm just a simple guy. And, kind of put it like this, and maybe this makes more sense. And this is the way I see it. And I could be totally wrong, but this is the way I see it. Think of a dam, right? The dam's the economy. You have a huge crack in the dam. That crack is supply chains. Where did inflation really start, and why is most of this happening? Because of supply chain issues, right? Why? Because we shut down the world, threw everybody in their house. Then all of a sudden said, go for it, guys. And then those warehouses and everybody that makes stuff for us went, where's our workforce at? Oh, we don't have a workforce because we laid them all off. So now we got to bring them all back. Wow, wait a minute. Now all the ships are showing up at the port all at the same time now? Yes. And so that takes a long time to work out, okay? And you still got lockdowns going on in China and all that kind of stuff. So, the crack is the supply chains. The water that's just up to the top of the dam is the demand, and it's flowing through, right? Just same rate of speed every second, right? So what is happening to that crack? It's getting bigger and bigger and bigger, right? So what do we need to do to fix the crack? How are we going to do that? Well, I'm not an engineer. I'm sure there's a way to do this without doing this, but this is the way I'm going to come at it. You got to get the water level down, i.e. the demand down below the crack, right? That will allow the engineers to come out and do their magic. Boom, 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 patch it up, get the supply chains fixed, right? At that point in time. And then later on, demand, it might creep back up. But if it does creep back up, guess what? Supply chains can handle it, right? Because they finally got the water lowered, i.e. the demand, and were able to repair themselves and get caught up, okay? And so anybody that's worked in a kitchen knows what I'm talking about. I was a restaurant manager for years, right? If you work in the kitchen, what happens when those dang hoses seat all the people at once? You got this ocean wave of orders flooding the kitchen, right? And the kitchen stays behind all night long. You ever been to a restaurant and you go, where's my food at? Well, that's what just happened. They got waved, right? A big wave of orders came in and they never catch up. Okay, that's the way it works. That's what happens to supply chains. Also, why you'll see inflation drop down is because they're literally going to be taking, and how do they get the demand down? They take money out of your pocket, literally, right? They raise rates, or like mortgage rates are going up now, right? So what do you see for mortgage demand? Dropping like a rock, right? Because people are like, I can't afford it anymore. Maybe I don't want to take out that kind of debt, right? And so as rates continue to go up on car loans, on credit cards, everything you can imagine, because we spend everything as debt, right? We don't carry cash around anymore. Then it makes people start thinking twice about, oof, I don't think I want to pay that. That's a lot of interest, and so that brings demand down. Okay, so the supply chains will be able to fix themselves, and then also taking liquidity out of the market will bring down this inflation and give us price stability in theory. Okay, so that to me, I don't know. Let me know what you think about that, analogy in the comments. That's about the simplest way I can come up with it. Again, could be totally wrong, but it makes sense to me. Okay, so if you're getting out of it, hit the like and subscribe button. I really appreciate it. And let's go ahead and just get into this and start off with this chart you saw in the thumbnail. And so here's your margin debt. This is in billions, right? And you should have seen this chart before if you watched this channel long enough, multiple times. And you can see the biggest thing I was waiting for too was to cross that zero line, okay? And sometimes I do this research, I have no idea what I'm going to find. But this is the big thing. When you cross that zero line right there, and you can see it happened all these different times back in 2018, 2020, we're not even going to talk about because that was a legitimate crash. 2016 it happened, and then 2011 to 12 it happened, okay? So that's what we're going to stick to. I'm not going back to 08 or the dot-com bubble. We know what happened there. We get it. No, we're going to focus on the ones where it wasn't a like legitimate crash from some crazy thing happening, okay? And when you look right here, when they cross that line, I have to kind of like gauge this a little bit because you can see there's not exact months on that thing, but I think I studied enough to figure this out. But you can see when that line crosses, when that margin debt drops drastically, right? You can see right here, you get a big drop right here in 2018 of around 19%. It was already dropping before then, right? I mean, you see the big whole drop. It was already down 7% before that. But then when it crossed that line, it kind of picked up and accelerated, right? And then if we go into 2015 to 16, you can see when it crossed the line around 16 and what, 0.4% right there. And then if we go down to 2011, you can see we're heading right into 2012, and you can see it was just a terrible year, a very choppy year, but you can see a drastic dump. And this was kind of weird. Even as it dropped, we actually had this run up here, right? Just like we just went through in March, you know, and so that was kind of interesting and kind of an anomaly, actually. And then if we go back, more importantly, we see if we draw a straight line across, you can see the margin debt in all three scenarios dropped farther below that line than where we're at now, right? So I don't know if that means we have farther to go or not. If we turn up from here and start heading higher, which would be kind of shocking, but if we did, it would be the shortest in history as far as going below that line right there. But the one thing I want you really to notice is what happens when that line all of a sudden turns around and starts heading higher. Normally it starts drastically heading higher. Do you notice that in 2011, 2012, 2016, 2019? You know, when it does turn, it starts to go. And you see 2019 was choppy as can be. But when it actually started to rip up, that was right before the crash. I'm going to show you what the market actually does. And so if we go back and we look at 2019, because this was after that crash coming out of that, you can see it ends up going up around 21% on the NASDAQ 100 in about 3.5 months right there. And then if we go up to 2016, you can see it went on a huge run of like 48% in about 1.5 years right there. I mean, 2017 was just an anomaly of a year. It was one of the best years I've ever seen on a chart, by the way. Not one single 10% sell-off. And then if you go back to 2012, it will be, you get, you know, it's kind of choppy in the beginning, very volatile, but then you have a 37% run right there over almost, looks like almost 2-year period. But you can see before that, even when the margin was going up, you saw these dips, right? You saw these dips and runs, dips and runs. And so it was extremely volatile. That's what I'm expecting to see, you know, this year, all through this year. And so for me, when I look at that, it lets me know one thing. It is, as you can see right there, that's from March, right? It just came out April 22nd, this past weekend. And, you know, you can see it's a lagging indicator. What it definitely tells me is until we get, you know, a big turn up and you see these big moves up, like we're not really going to go anywhere for that matter. I mean, it's just not really going to happen because why? What is our economy based on? What is our stock market based on? It's based on leverage. Without it, and if you look at that chart, you'll see how much margin was out there versus the dot-com bubble. I mean, we've never, in the amount of billions of dollars, had anywhere near this kind of margin out there. I mean, all you need is a pulse to get it. I swear I say that, you know, jokingly, but they'll give you. I mean, it's like anybody gets a credit card. You ever know somebody, you say, how in the world they get that house? There's no way they can afford that house. The bank gave them the loan. They say, sure, go for it. You good, whatever. You know, because they can just take the house. They don't pay for it. So same way they'll take your stocks, right, if you get margin calls. So, you know, they're not really sweating it. And so, you know, leverage, leverage, leverage. That's what it's all about, right? That's what makes the volatility so huge, especially, you know, this year right here. But you can see risk off, right? What's everybody done? I'm going to push that margin to the side. I mean, I opened up a margin account, for God's sakes. I don't use it, especially in this market. Why'd I open it up? Because I'm just waiting, right? It may be a long time I'm waiting, but I'm just waiting. Like I told you in the video before, yeah, they're going to raise those rates. But what do they always do? They always break something, and they have to go, oh, my God, we got to freeze. And as soon as I've showed you on the chart, what happens when they announce we're going to freeze rates, and then right when they lower them, what happens? Huge spike up in growth stocks, right? So I'd rather just have that, you know, margin / i.e. credit card sitting on the side right there in case I need it, because I know, according to historical patterns, what's going to happen. It may take a while, but I'm a patient man, and this is, you know, this is going to test. I was talking to somebody in the comments about this. Test people's patience, right? This is going to be one of those markets where it's going to be highly volatile, ups and downs like crazy, you know, and if you let your emotions get the best of you, you know, good luck to you. That's just kind of the way it is, but that's what kind of the market this is because, yes, eventually, it may take 6 months, a year, 2 years, who knows, for the market to start going higher. But yeah, I mean, that's what normally happens unless things all of a sudden, stop repeating historically. But if you look at the charts, that's what it is. Right now, we're just in this moment. You can see it right now in the FANG stocks where they're just bringing those valuations down, right, to get to a certain number, wherever that is. Who knows? We'll have to see. And then from there, we'll move higher eventually. So anyway, just want to put that out there too. You can see that. And also we can use this for the future, right? I mean, it's going to happen again. You see, like every, 2 to 3 years minimum, this happens where you see margin start to tank. I remember I was talking about last year, and I said, we really got to watch this. We really got to watch this. But as that line is the key. When it crosses that line right there, that's when you're like, okay, now things are really interesting. But you saw, even before that, right before the line, that's when we started selling off. So, it kind of lets us know, are people going risk off or not? It's not even a guessing game anymore. So now that I know how to use this even better, that's something we just got to stay apprised of. We can use in the future with other indicators and stuff that we know about. And so, hope you got some out of it. Hit the like and subscribe button if you did, and I'll see you guys tomorrow.